Hi, I'm your host, Bob Powell. We're proud to welcome you to the Exceptional Advisor podcast series brought to you by the Investments and Wealth Institute. This series aims to help you to better serve your clients, differentiate yourself from the competition, and enhance your ability to communicate those differences. My guest today is Ann Sonders, Managing Director, Chief Investment Strategist for Charles Schwab & Company. So welcome to the podcast, Ann.
Oh, thanks. Thanks for having me.
Pleasure. So for the benefit of the very few people who may not be familiar with you and your work, do you mind giving us a brief overview?
Sure. So my functional title is Chief Investment Strategist at Charles Schwab, and that covers both the full retail side of our organization, as well as every other component of Schwab Advisor Services, retirement plan services. So the output of my work is written report, videos, and client events, both in person and virtual, podcasts like these, both internal and external. And I'm very active on Twitter, but I view myself as an interpreter of what's going on from a big picture perspective and hopefully framing it in a way that makes our investors more educated and gives them a helping hand as they navigate the world of investing.
Yeah. So we should mention your Twitter handle before we go on. What is it?
It's at Ann Sonders, so LIZANNSONDERS.
Right.
I only spell it because I have had a rash of imposters that will either add a Z to the Liz part or add an E in the end or add an exclamation point. And so just make sure if you're following me, you're following me.
The real Ann.
The real, yeah, the blue check mark.
And I should note before we get started that you'll be speaking at the ACE Academy in May in Nashville. I know folks will get a big treat out of that. So I hope that they register to attend and get a chance to hear you in person, not just in a podcast.
Thanks.
So let's start with what is probably top of mind, which is the volatility and weakness in the market so far in 2022. So much of it's probably associated with the Russian invasion of Ukraine, but some of that weakness predates the invasion.
Oh, absolutely. In fact, if you just look at calendar year 2021, which obviously was well before Russia's invasion of Ukraine, it was seen as a year where the market was quite resilient. And on the surface, there's nothing not factual about that statement. We had very limited drawdowns in the case of the S&P at only about 5%, concentrated in that September period of time. You did have an official correction for the NASDAQ, which had a 10% decline, but the weakness under the surface was more pronounced than what you would notice if you were just looking at index level changes. In fact, if you looked at all 500 stocks in the S&P and looked at the average maximum drawdown for the year, it was 19%. That's just shy of bear market territory. It was 43% for the NASDAQ. What happened, though, was the weakness was concentrated way down the capitalization spectrum, such that in these cap-weighted indexes, the weakness was not hitting the big behemoth names that drive the index. So it wasn't picked up by the averages. That changed as we came into this year, even pre the invasion. We started to see that weakness sort of infect up the cap spectrum. And we got official correction in the case of the S&P, bear market in the case of the NASDAQ and the Russell 2000. We've had a bit of a relief rally recently. I think a lot of that is short covering, but I think we're at the mercy, obviously, on a continued basis of headlines out of Russia, Ukraine, and the Fed is back in the spotlight. They were in the spotlight. Russia, Ukraine took them out of the spotlight a little bit, but they're clearly back in the spotlight with what will be tighter monetary policy already underway.
Yeah. So you've referred to this as a stealth bear market. Mm-hmm. Elaborate on that.
So stealth means, in my terminology, this churn and weakness under the surface, that it happens, the corrective phases happen through a process of rotation, even last year, where you have pockets of weakness, but it's offset by pockets of strength, and it nets out to more limited declines at the index level, but more significant weakness under the surface. And I think that is likely to continue. We've seen some more resilience on the part of the indexes recently because some of the strength in this relief rally has been, again, concentrated back up the cap spectrum. But the combination of not just the short-term impact of Russia, Ukraine, But a lot of what will likely be the longer term impact that we're just all starting to digest right now, not to mention the Fed having moved from just unprecedented amount of stimulus to now very quickly moving toward tighter monetary policy, probably keeps volatility, at least in bouts, relatively high.
Yeah. So as you think about the Fed increasing interest rates and its impact perhaps on smaller cap, less profitable companies, do you see that there could be an extended bear market for these smaller cap, less profitable companies?
I think so. I think we've had, really for the past 2 years, we've had these narratives that have come and gone in terms of driving what's doing well and what's not. Certainly one of them early on, 2 years ago or so, was driven by what I would call low quality segments of the market. Actually, I should say a year and a half ago, where when we started to price in not just a better economic trajectory once we got the vaccine news, but an actual sort of real acceleration in economic growth, as is often the case when you start to price in an acceleration in economic growth, you get this low quality trade because that's where the leverage is to an upturn in the cycle. That's often where you've seen the most damage during the preceding, bear phase or recession phase. And that certainly happened a year and a half ago or so in spades in the case of areas like the meme stocks, as you mentioned, non-profitable tech, weak balance sheet companies. I think leadership there, other than maybe for very short periods of time where you get bottom fishers coming in, I think that's largely in the rearview mirror. And in part, it is due to tighter monetary policy, tighter financial conditions, interest rates going up, which tends to put downward pressure on more highly valued or more speculation-driven segments of the market, longer duration segments of the market. Now, that doesn't universally apply to small caps, but I would say it applies to any company that has weak fundamentals, including negative earnings, stocks with above average volatility, with high debt and limited free cash flow. I think you might want to trade some of those low quality areas, but I think from a fundamental standpoint, I think leadership will continue to be now in that sort of quality wrapper that we certainly saw in relative terms during the corrective phase most recently. Again, we're going to see pops, as is typically the case when you get these trading rallies. I wouldn't chase that type of category. I would stay focused on quality in this type of environment.
Right. So in one's focus on quality, when I look at something like the CAPE ratio, does that concern you at all with its current level?
I look at every variety of valuation metrics. I don't tend to focus to a significant or universal degree on Shiller's CAPE. Many years ago, I wrote about some of the problems that are inherent in a metric like that, given that it's a pure 10-year look back. And if in that 10 years you have sort of an epic dislocation that causes not an artificial implosion in earnings, but one that is somewhat short-lived, just in terms of how that ratio is calculated, I think it can sometimes suggest an overvalued market for an extended period of time. I would say, though, about any valuation metric, even your standard forward PE ratio, I would tell investors, don't ever think of valuation as a market timing tool. First of all, I don't believe in market timing in the short term, but if you're going to try to find metrics that give you maybe an edge from a market timing perspective, valuation is not one of them. It tells you absolutely nothing in the near term, call it a year or so, about what the market is going to do. If anything, valuation is as much a sentiment indicator, or maybe better put, an indicator of sentiment. And I think that we clearly see in both directions, really excessively optimistic, lofty expectations periods like the late 90s into 2000, where you saw valuations go into the stratosphere, but that was the mood and the psyche of the investment community at that point. Fast forward to the early part of 2009, you couldn't give stocks away. So I think of all valuation metrics as more valuable for a long-term time horizon. And where Shiller CAPE and most other metrics can help is looking out, say, 10 years
Mhm.
to get a sense of whether returns are more or less likely to be, above or below average. And I would certainly put Shiller Cape in there. The one metric that troubles me most, or I ponder the implications of most, is the so-called Buffett model,
Mhm.
which named that or nicknamed that because it's Warren Buffett's so-called favorite valuation metric. And it's the total market cap of the entire market. And some use the Wilshire, some use Russell 3000, but basically beyond just the S&P, divided by GDP. And we've never been as high as we are right now, well higher than where that ratio was even in 2000. And that doesn't signal imminent doom for the market specifically, but it does tell you that the stock market and the economy have never been more connected, which has a circular relationship to it, meaning any serious corrective phase or bear market in the market will probably have an outsized impact on the economy, much like was the case when the tech bubble burst in 2000. Conversely, a weaker economic period could infect the psyche of the market more maybe than it has in the past. So that's the one I find most intriguing to ponder right now.
Yeah. And speaking of the economy, there seem to be some headwinds facing it at the moment. For instance, I think about the Fed unwinding its balance sheet or the war in Ukraine and its effect on food and energy. Care to comment on both or either of those?
Yeah. So, the rub, of course, with regard to Russia, Ukraine is that we were already in a weakening economic environment in the face of very high inflation, now only exacerbated by Russia invading Ukraine and the impact that that not only has had, but will likely continue to have across the spectrum of commodities, energy, food. And I don't think the world has yet digested the longer term implications of this, even in a best case scenario where tomorrow we wake up and find that Putin has come to his senses and there's a ceasefire and a negotiated end to this. I just don't see the world going back to business as usual. Certainly not relationships at the country level, at the corporate level with Russia, which means you have to start to assess what the world looks like with less of that oil and less of that food, and what are the ripple effects into emerging markets. I mean, we could spend a whole nother podcast on just that, but we were already in a weakening economy. And the best way to describe what was already underway is less stagflation. You want to be precise with the definitions of some of these terms. Stagflation, of course, born out of the 1970s, was not really just weak growth and high inflation. It was specifically high inflation and a high and rising unemployment rate. Mm-hmm. So if you want to be pure to the definition, we don't have that situation at present, not to mention much higher productivity now. Demographics were a lot different, unionization, et cetera, et cetera. I think the better descriptor, if we want to use Econ 101 kind of descriptors, is either countercyclical inflation or cost push inflation, where prices go up to such a high level that it starts to put downward pressure on demand and in turn downward pressure on growth. That's the environment I think we're in right now. And the Fed's in a pickle because they're behind the curve. They know they're behind the curve. They know they have to ramp up tightening, but they're doing it in a slow economy and with inflation sort of already running away. And so this tightening cycle doesn't really have a lot of precedence, not to mention what they're also going to do with a $9 trillion balance sheet, where there's no precedent for trying to shrink that simultaneously. So we're in uncharted territory here.
Right. And against that backdrop, we're looking at maybe not full employment, but certainly low unemployment and wage pressure too. Any thoughts about that?
Yeah, well, the wage pressure is certainly up. The rub for those earning those wages is that even where wage growth is highest, which good news in relative terms, it's highest down the income spectrum. So it's lower income folks that are seeing in percentage increase terms the highest wage growth. The problem is, even if you find the cohorts that have the highest wage growth, that percentage increase is still lower than the rate of inflation. So whether it's wage growth, whether it's personal consumption, savings, personal income, a lot of these metrics that are reported in nominal terms If you look at them in real terms and subtract the current rate of inflation, you're talking about negative numbers. And that's the real rub right now, especially down the income spectrum, where high inflation, especially in areas like energy and food, acts as a regressive tax because lower income folks simply spend a much greater proportion of their income on those types of goods.
Mm. So we mentioned one data point to follow, the Buffett index. Any other data points that you would think would be crucial for folks to pay attention to as we think about wrapping up this first quarter and moving into the rest?
Yeah. So I think it's always important, if you're trying to gauge where we are in the economic cycle, to focus most on leading indicators. We often concentrate sometimes on indicators that are the more common, popular, well-known metrics like the unemployment rate, but that's one of the most lagging of economic indicators. So it really doesn't tell you anything about what's going to happen. It tells you everything about what has happened. So, the indexes that are collective sets of leading indicators like the LEI out of the Conference Board, you've got more recent, more kind of COVID era modern leading indicators that were cobbled together by the New York Fed in an index called the Weekly Economic Index, which by virtue of it being weekly and not monthly like the conference boards, it's a little more real time. And they incorporated in some of the economic metrics that get more directly to the heart of where the constraints in the economy have been, specifically due to the pandemic. So always you want to focus on leading indicators. The yield curve, I think, is always important. I just wrote about the risk of recession recently and also talked about the yield curve. Sending mixed messages right now. Recently, the 10-year 2-year came pretty close to inverting, but the 10-year 3-month is still really, really steep. I think there are there's just some differences in terms of what's embedded in these yields by virtue of this unique period of monetary policy and quantitative easing. But given that an inverted yield curve is actually not typically a cause of recessions, it's a symptom of the conditions that lead to recessions. Almost every cycle you hear people say, pay no attention to the yield curve. It doesn't matter anymore. I don't know about that. It's had a pretty darn good track record. The better track record with nearer term timing is the 10-year 3-month. And again, that's still pretty steep, but I'd keep an eye on the yield curve. And then what we hope to see is a start to a rolling over in some of these inflation numbers. Even if energy and food prices stay elevated, if they don't continue to accelerate, we're getting to the beneficial base effects where the year-over-year comparisons will start to be less robust, certainly at the core level of inflation. I think that would ease some concerns if we just started to see less eye-popping numbers on the upside. So that would be a kind of a general collection of what I'd keep an eye on.
I still think when I look at the components of inflation, and I think used car prices at 40%, it seems like at some point we will have bought all the used cars there are to buy, and there won't be any more inflation.
There's still, the prices are still up a lot, but the rate of change is coming down. And that's another really, really important message that I think investors should be reminded of over and over. Often as investors, when we're looking at economic data, whatever it is, sub-level economic data like used car prices or big picture economic data like job growth, whatever it is, as human nature suggests that we think of them as good versus bad or strong versus weak. But better or worse tends to matter more than good or bad, especially at possible inflection points. And that's what's often missed because, here's sort of a thought experiment. If the economy is as weak as a metric like the Atlanta Fed GDP now suggests it is, which has just a little over 1% growth expected for the first quarter. And a lot of that data predated the Russian invasion of Ukraine. So if anything, it gets worse, not better. Let's just assume that it gets worse from there. And whatever it is, 2 quarters from now, the NBER, the Bureau that dates recessions, says their business cycle dating committee is sitting in a room and they say, you know what, we're in a recession. What they do when they decide or date the start to the recession is they go back to the peak in economic activity. So that narrative, if it were to unfold, suggests that if we're heading into a recession, we could already be in one, given that the peak predated you and I having this conversation now. That doesn't mean we're not going to have jumps and fits and starts. We certainly could, but that's just something to think about, that starts of recessions, because they get dated at the peak, the data in an absolute sense, in level terms, looks great. Yeah. You just didn't know at the time that the path from there was going to start down.
Yeah. What's the analogy? A frog in a pot of water that's about to boil?
That's right.
Something like
and
that.
The same thing, by the way, happens when you're coming out of recessions. When the NBER ultimately says, okay, March of 2009 or May of 2020 was the end of the recession, or April 2020, they go to the trough in the data. By definition, at the trough, in a snapshot terms, everything looked horrible. But that was when things stopped getting worse and started getting better. At the peak, they stop getting better, they start getting worse. So that rate of change, you've got to have sort of that second derivative filter on in an environment like this when looking at economic data, inflation data.
I really wanted to talk more about COVID and such topics as the Great Resignation. Can you talk a little bit about what happened during the Great Resignation and where we are with COVID?
Not that any of us were hoping for Russia to invade Ukraine, but to the extent that there was some hope that COVID would leave the top of the full front page of the newspapers, sadly, that ended up being the reason, but it's not yet in the rearview mirror. And we know for the past 2 years, it has really changed so much about everything on our economy, what the reaction function has been, both by monetary authorities and fiscal authorities, and how many wrinkles it's thrown into economic data and how we analyze it. And, clearly some of the kind of shifts that have occurred thanks to COVID, including more hybrid work structures and flexibility, has been a contributor to the less robust pickup in the labor force participation rate, the quits rate being as high as it is, the so-called Great Resignation. Some of it is just the psychology of going through something like this and rethinking, what do I want out of life? And in some cases, it's people quitting because they see opportunities to work elsewhere in another industry, in another company, where they might have greater flexibility, where they might not be at the mercy of health problems. I mean, there's such a long list of reasons. Interestingly, you and I, before the break, talked a bit about high wage growth. It's not high in real terms, but high in nominal terms. But another breakdown that is interesting, we talked about low income wage growth being higher than high income wage growth, but the wage growth for job stayers is about 1% lower than the average. The wage growth for job leavers is about 1% higher. So right there's that incentive to shift. We have started to see a pickup in labor force participation, though. I think the savings rate is back down to kind of pre-pandemic, actually slightly sub-pre-pandemic levels. Yes, the stock of savings is still high. I'm not a big believer that should be assumed as automatically coming back into the economy, especially given high energy and food prices. So I wouldn't be surprised to start to see less robust, broad labor market data. You've started to see a little pickup in layoff announcements. You've seen a little bit of a moving down in job openings, nothing significant, but again, it's inflection points in rate of change. We had a high in the quits rate of 3%. That's ticked down a little bit. So you definitely want to keep an eye on these, because we could be at that inflection point where not that story broadly is in the rearview mirror, but the acceleration may be in the rearview mirror. And in terms of related, the fairly anemic recovery in labor force participation, one of the primary reasons why folks said, I'm not coming back into the labor force, is actually because they, hit the number,
Right.
hit the retirement number.
Yep.
We'll have to see whether any kind of protracted corrective phase or period of volatility could start to bring some folks back into the labor force. But we're slowly getting to a point where all labor market data will be less skewed by the unique characteristics of the pandemic.
Yeah. So speaking of the pandemic, looking in the rearview mirror, much has been said about the amount of fiscal stimulus that was injected into the economy and its effect. Any thoughts about that?
It was to a degree beyond anything we've really seen, other than in World War II type times, where a very different reason for the stimulus directed in different ways. But what's to me most interesting about that is not so much the speed and the scope of what was done by fiscal authorities, but what many assumed that would unleash that actually didn't come to fruition. And what I mean by that is, we massively ramped up fiscal spending, which then you had the, modern monetary theory folks coming out of the woodwork, those in favor of it saying, see, this is how you pull an economy out of a crisis. We need to do more and more of this. Those on the anti-MMT side said, oh my gosh, we've unleashed this barrage. Look what's happening to the budget deficit. This is going to be a disaster. We actually got a little bit of both. We saw the benefits of that much fiscal stimulus applied directly to the heart of the problem, fed right to small businesses, to individuals, done through programs like enhanced unemployment insurance. But for a variety of reasons, it didn't feed on itself beyond the point of necessity. Now, there'll be debates forever. Was too much done? Was not enough done? Should it have been stopped earlier? Same with the monetary side, but all of that's sort of the ultimate counterfactual. The debates will go on, but we'll never truly know, okay, was it too much? Was it not enough? But we'll certainly hear those debates. But then the combination of how quickly the economy recovered, but how much inflation came along with it, plus people like Joe Manchin being the decider in Congress that wasn't on the right side of the spectrum, we sort of put a halt to this slippery slope toward MMT, which I never thought we were going to go down there. So maybe the collection of everything that happens could be seen in a beneficial light, in that we see the power on the fiscal side in the short term to tackle a problem side by side with the monetary side, but it doesn't necessarily open the floodgates, which maybe extenuating circumstances didn't allow it to open the floodgates. But it's just been an interesting sort of transgression over the past couple of years, going from this extreme and the deficit hitting 14% of GDP, now been cut in half, the biggest improvement in the deficit in a one-year period since World War II. So it's been fascinating to be an observer of this. I think the Fed is probably more, I don't want to say at fault, but I think it's easier to say maybe the Fed made a bit of a mistake by maintaining their stimulus with still adding to the balance sheet and keeping rates at zero beyond the point it was probably necessary. So that's the irony, is that the fiscal side sort of put the brakes on more quickly than the monetary side.
Yeah. I think from a historical perspective, I think back to 2008 and Biden sitting in the room talking about TARP and whatnot. And, the notion of, did we put enough money in or not enough, or et cetera, probably, I'm guessing, weighed a little bit here on decisions in terms of how much to pump in.
Right.
So let's turn back to the stock market in terms of what you think the biggest risks are that investors face. And since our audience are largely advisors, what they need to be thinking about and telling their clients.
So I think the biggest risk is I suppose the obvious risk, which is that we have a recession and not a soft landing. Anytime you shift from very easy monetary policy to tighter monetary policy, you start a rate hiking cycle, there is a risk of recession. It's imperative always to dust off the recession playbook or checklist when you're in this monetary policy shift. And the Fed has, whether you can define it as the Fed engineering a soft landing or the collection of circumstances, including what the Fed is doing, results in a soft landing, not a hard landing. More often than a soft landing is a hard landing, especially when you have the added negative kickers of an economy that was already slowing and the deleterious impact of the inflation environment and energy and food prices. So I think recession is the biggest risk right now. There's always the black swan risk. Sadly, we've been bombarded. There's a lot of them been flying around in the last couple of years with a pandemic and now a war between Russia, Ukraine. It'd be nice to actually get a white swan every once in a while where you get this, shock that's on the positive end of the spectrum, but that always is there. I think related to the 2 years ago black swan could be something COVID related that isn't just another variant like, Omicron BA2 or whatever it's called. That is that something, a variant shows up that is vaccine resistant or more deadly. I'm not predicting that, of course, but you can't write off pandemic related shocks or risks, unfortunately. Let's hope that that's in the rear view, but those would be two risks. And then, of course, if this war goes nuclear and turns into World War III, with us having to get involved more directly from a military perspective. That's probably the worst possible risk.
Yeah, all bets off at that point, I suppose.
Yep.
What about earnings season? Any thoughts about that?
Yeah, earnings season was very strong, again, in an absolute sense. Certainly a deceleration in terms of the growth rate off of last year's second quarter, which earnings growth for the S&P was up almost 100% in the second quarter of last year, in large part because the comp a year earlier was the lockdown quarter. So that's just the math of year-over-year comparisons. And for the fourth quarter, which basically we just finished reporting, for overall S&P, I think the final number is around 32%. Ex energy, it's 23 or 24%. Expected to continue to decelerate. But under the surface, where you've also started to see deterioration that is worth keeping an eye on, is the beat rate. So for the period coming out of that second quarter of 2020, coming out of the lockdown quarter, beat rates were consistently around 85%, which is well above the long-term norm of about 65%. Mm. The most recent quarter, that was back down in the mid to high 70% range. And the percent by which companies beat estimates was low single digits versus, in the teens for the 6 or so quarters prior to that. So again, snapshot, earnings still look great, but we're in that deceleration. And then more important looking forward is that the negative revisions on a forward-looking basis now outnumber positive revisions. So the revisions ratio has moved down into negative territory. So we may be past the point where for really 6 quarters in a row, we had this tailwind of analysts just having the bar set too low. We may be at a point where analysts now haven't lowered the bar enough, especially now given what's going on with Russia, Ukraine, which I don't think analysts have yet fully tried to capture in forward-looking earnings numbers because there's just too much uncertainty at this stage.
Yeah. So given all that, any thoughts about where to overweight, underweight, equal weight?
We actually very recently, about a week or so ago, for temporarily, most likely, neutralized all of our tactical recommendations at the broad asset class level and even at the sector level, feeling that there were so many unique near-term uncertainties associated with the war that trying to sort of attach trading opportunities around that short-term uncertainty, we just weren't in any position relative to anybody else to be able to assess that kind of landscape. So felt the best way for investors to navigate in the near term is to not make bets, but actually use your strategic asset allocation, kind of market neutral sector allocations, and the volatility tied in the markets through disciplines like rebalancing to stay in gear that way, and have your sort of anchor of your strategic asset allocation, sector neutrality, but the swings that are happening give you an opportunity to add into weakness, to get back in line, to trim into strength. And so for now, we're not actually recommending any bets. I think it's such a weird potential outcome. If you think about the tails, the ultimate horrible tail, right tail risk is what we already touched on, World War III, nuclear. As an investor, there's really nothing you can do to hedge against that. That is an all bets off scenario. But you don't want to position for that by just saying, I'm getting out of absolutely everything, mattress, here comes my cash, because as we've just seen in the past few weeks, even without a resolution, a headline can cause just a ripper of a move higher. And if there is some sort of resolution, that could cause a significant move on the upside. So those are sort of the two tails. The reality in the middle is this sort of back and forth volatility driven by the Fed, driven by the war. And we've been suggesting maybe if you can, based on turnover implications, et cetera, maybe take more of a portfolio-based approach to rebalancing as opposed to a calendar-based approach. So if you're an investor that just will rebalance, say, on an annual basis, maybe let your portfolio and the moves therein dictate when maybe you should do some trimming back or adding, depending on what's happened with swings in the market.
Right. So given the Fed and Ukraine, have you changed capital market expectations of late? Or?
No, because those are multi-year projections that we have, and they're not surprisingly not lofty forecasts. They're in line with probably most other firms, and I don't even know them off the top of my head, but sort of collectively in that low to mid single digit range, with maybe outliers depending on how far out the risk spectrum you go. But 3 weeks into a Russian invasion of Ukraine is not going to be. It certainly was a trigger for making a shift to those tactical shorter term recommendations. But at this stage, no, we haven't changed our longer term capital market projections.
Yeah. So we're almost running out of time. If anyone was just to listen to the final 3 minutes of our podcast today, are there some key takeaways that we should leave folks with?
Yeah, I'll kind of maybe summarize by some of my well-worn adages that I've been using and saying for my 36 years in this business. One we touched on when we were talking about economic data. Remember that better or worse tends to matter more than good or bad, that we have to be really mindful of direction, more, at least as much as level. Don't fight the Fed. I learned that from my first boss for 13 years in this business, the late, great Marty Zweig, who coined that phrase. You definitely want to bring that back into the front of your mind when you're in a Fed tightening cycle. For traders or investors who think the key to success is figuring out what the market's going to do and then making wholesale adjustments, I don't know any successful investor that has become successful by making all or nothing. I always say neither get in nor get out is an investing strategy. That's just gambling on moments in time. And really just going back to the tried and true disciplines around diversification and rebalancing. I suppose as boring as they are to talk about, they're not going to grab headlines on the financial news networks, but it really is the best advice. It's not what we know as investors that matters, meaning about the future. It's what we do along the way.
Yeah. Well, Liz, I want to thank you for joining me on the podcast today. We so look forward to you speaking at the ACE Academy in Nashville and for today sharing your knowledge and wisdom with our listeners. It's greatly appreciated.
Oh, thanks so much. I look forward to Nashville as well. And Bob, thanks for having me.
Pleasure. Thank you for listening to the Exceptional Advisor podcast brought to you by the Investments and Wealth Institute. If you've enjoyed this podcast, please subscribe through iTunes, Spotify, or our website at www.investmentsandwealth.org/podcast to get the latest episodes of our Exceptional Advisor podcast series. For additional resources, updates on events, and exclusive membership deals, visit www.investmentsandwealth.org.